Hello, and welcome to the Consistent Profits Podcast, brought to you by Inside Out Trading and Brian McAvoy, where the focus is on consistency. Because when you have the consistent part down, profits become easy. Hello, everybody. This is Brian McAvoy with another episode of the Consistent Profits Podcast. I'm excited today to be interviewing Serge Berger. He's creator of thesteadytrader.com and also Blue Marlin Advisor. And we're going to be talking about both today. Thanks so much for being on the podcast, Serge.
It's great to be here, Brian. Thank you.
Now, for those of you not already familiar with Serge, he's been an active trader since 1998. During his career, he's been a financial analyst. He's dealt in fixed income instruments at JP Morgan and was a proprietary trader in equities, equity options, and futures. Having had exposure to a range of different asset classes allowed him to identify which asset classes and strategies best fit his goal of achieving consistent profits. Over the years, Serge has created a trading methodology that divides markets into different time frames and characters, allowing him to more clearly and without emotions determine the strategies to apply in different situations. He uses a repeatable, rules-based approach to the markets. Now, along with being a seasoned veteran, Serge is an investment advisor, and we're going to speak to both of those today. So, again, thanks for being here and being game for the interview, Serge.
Thank you so much. I appreciate it.
Okay. Now, as far as getting into all that you have, I mean, trading is a very unusual occupation. Not very. We're a small percentage of the population. So, how did you actually get your start in trading?
I started trading. I was a golfer in high school, and then went to university for that as well. But when I was playing in high school, I used to, of course, on the weekends and in the evenings, play at the golf course at home, and I would play with these gentlemen that were, rather well off, and they were seemingly much older, much younger now that I think about it than that they seemed to me at the time. So I don't think any of them were a lick over 50. But they were just playing golf all day, and they had these TVs in their cart, and they were on their phones. Remember back in the days where this is the dinosaur brick phone, and they were watching these squiggly lines on TV between golf shots. It was like futuristic. And so anyway, I got into it then, and I ended up actually managing a little bit of money for one of the guys a little bit together with him in high school, and then I went on to college. Went on to went the whole investment banking thing. Worked at JP Morgan, as an investment banker, and then moved on from there to the fund management side, okay. Which in many ways I reside to this day at Blue Marlin Advisor.
Okay. Now, but so when did you actually start trading your own account,
though? My own account. Well, I didn't really have much money until college. Okay. And even then it wasn't much, right? Yeah, even then, so, yeah. But yeah, no, probably in college, right? But I think, one of the things about trading and investing is there's a steep learning curve, and it's actually a quite long learning curve. And so I was fortunate not to blow up my fortune too many times and get my hopes up too much until later on. I mean, you always end up blowing up a couple accounts. I think that's par for the course, yeah. Literally. But yeah, I think I was fortunate and unfortunate in many different ways. It's life has ups and downs, but fortunate enough that I was able to learn, really see the inside of the market through the lens of the investment banking at JP Morgan, right through the great financial crisis. And that really taught me a lot of things about kind of principles we live and die by right now on the fund management side.
Oh, okay, cool. Well, so you've had an interesting career path, and so you've had some unique, looks at the market, been able to learn from some different people, how they perceive it and everything. I've heard you make the comment, or actually, there's a couple of things I wanted to ask about. The first one would be, I heard you on one of your recent YouTube videos, you posed the question: is the golden age for stocks over? And so I'm curious because, yeah, a lot of people are kind of asking the same question just because of the run we've been on, but what we're seeing lately. So if you could expand on that, that would be excellent.
Sure. Well, as you obviously know, we've had a big run, largely due to lots of essentially fiscal spending and monetary policy ultra loose. Ultimately, interest rates went near zero in the United States. In parts of Europe, they actually had negative interest rates. And then that came to an abrupt halt about a year and a half ago.
Mhm.
And so we're now at a point where interest rates are, in absolute terms and historically speaking, not all that high.
True.
The problem is that we went from zero or near zero to 5.5% over the course of 18, 19 months.
Mhm.
And it's that shock to the system, that resetting, that I think a lot of people are not aware of what that historically at least has done and meant for future returns in the equity market. And oh, by the way, the S&P 500 has actually gone nowhere in 2 years, zero, right? So I think a lot of people are just not quite aware of what is actually happening, because there's only 7 stocks that are driving, things higher. Like even just the other day, everyone made a big deal. CNBC had like a special session about how amazing the stock market is on a day when the Russell was down 1.5%, the S&P was up by this much, and the equal weighted S&P was that way. It was just, it's laughable, right? Notice I'm not saying this is the end of the world and the stock market's going to crash. That can happen. That's not my base case.
Right.
I just think we need to understand that in a higher interest rate environment, higher than we have for the past 10 years, things are going to reset. And
Oh, yeah.
that is what I mean by the golden age for stocks, which does not mean that some stocks can't do great. Some stocks will do amazingly well, but it won't be the S&P 500 most likely.
Yeah. Well, just some, you mentioned a couple of things that have been really pertinent to what we've seen over the last several years, like the near zero interest rates. I know one thing a lot of corporations were doing was they were borrowing because it was almost free money to buy back their stocks, which made the like the CEO and everybody look real good because they're able to float their stock prices, and so they're getting their bonuses, and it's like, no, they're not really adding value. But then you've also, and so the easy money has made it easy for a lot of corporations that now, with things being more traditionally priced, it's going to be a little more challenging. Because yeah, like you mentioned, I remember growing up, the standard common interest rate was around like between 4 and 7%. It kind of floated around in that range. And then when it dropped down to near zero, that was the anomaly. It just lasted for a long time until everybody got used to it. So for there to be some interest, but yeah, it was the jump that really had the big impact, and how that affected the bond market as well. The jump in interest and bond yields.
It's exactly right. And people's memories run short. What we know is that the typical do-it-yourselfer or retail investor at home tends to do an asset allocation of longer term money based on what the stock market did the past 3 months. Right? So that tells you a little bit something about that. Most do-it-yourselfers do a lot worse, by the way, than the people who have at least some sort of an investment advisor, which we can always talk about that later. But let me just say one other thing about this, if you don't mind, about the question or you pose about the golden age for stocks.
Mm-hmm.
First of all, we didn't really have much of a golden age for stocks to begin with. There's only a few stocks that actually did really well the past 10 years. That's another thing. In the United States, that's true. The German DAX is unchanged for, I don't even know, it's ridiculously long, because the German DAX has dividends calculated in there. If it didn't have dividends in, the DAX would be flat for like about as long as you can look back, like with a reasonable time frame. And it's not that much different for the S&P 500. So a lot of people are just not aware that the average stock hasn't done much.
True.
The other thing that I would say about this, I just got back from a conference a few weeks ago. It was an investment advisory conference for investment advisors and money managers.
Mm-hmm.
And I was walking around the convention hall, the booths where they offer stuff. And I was looking at all these different funds and prospects and brochures, and every single one of them I flipped through went back, showed us a track record.
Right.
You got to have a track record. And then we had lunch with a bunch of other fund managers, and I was like, "Did you guys notice something in that convention hall over there?" And they're like, "Oh, no." And I was like, "Did you realize that every single one of these brochures went back exactly 11 years? Like none of them went back more than a decade." Like, did the stock market like start 11 years ago? No, but the stock market, and I'm going to use the bubble word here loosely, right? But
Right.
the vertical leap started 11, 12 years ago at this point.
Yeah.
So every damn asset, excuse my language, in the world there basically went straight up because rates went down,
Right.
right? I mean, it's laughable. The whole thing is laughable. Now, it's not to mean that we can't make money from that. In fact, the easiest trade, the best trade over the past 11 years until about 2 years ago was to just buy the S&P. It was amazing, right? That's why everyone felt wealthy. But now we've gone sideways in 2 years and people are way underweight bonds and they don't want to buy bonds because they think it's boring because, hey, I can buy NVIDIA. So anyway, I'm going off on a tangent. I know, sorry, but I hope that at least somewhat addresses your question you're asking before.
Oh yeah, yeah. No, that was excellent and yeah, entertaining as well. Um, well, as far as the golden age, well, just in general, I mean, because one other statement that you made that I definitely wanted to see, what it is that you're saying behind it. I've heard you make the comment that most people don't understand how the stock markets really work. And so, yeah, what did you mean by that? Because I mean, of course, most people, they look at the stock market, they've learned what they've learned, have been exposed to it, what they haven't, so they feel like they have a decent handle on it. But as we know, that's real easy to do with a lot of things and still be missing some critical information or
Yeah.
perspective. So, yeah, if you would enlighten us a little bit on that.
Yeah, there's a lot of different points on that. I'll try to highlight on sort of the most interesting ones if I can kind of figure out the order. The first thing I think would be that I think there's a big misunderstanding about timing.
Okay.
So, like for example, this was about 4 years ago. It's just before the pandemic. I got a call from CNBC. It was pretty late in the day, like a 5 p.m. day or 4:30 call, and they wanted me to go on and be bearish on Apple. They were telling me what my view was.
Oh, really?
And then I was like, okay, well, first of all, I'm not bearish Apple, but let me hear you out.
Right.
And they said, oh, by the way, you're a day trader. I'm like, I'm also not a day trader, but whatever. And I was like, okay, well, what's the point? They're like, well, you have to make this bearish case on Apple against this other guy who's long-term bullish. And his name is Kevin O'Leary. It's some guy in CNBC.
Right.
And I was like, okay, well, first of all, that's dumb because that's not my view. And second of all, what's even dumber is that he's long-term. I'm supposed to be short-term. That's like that you can't even have a conversation that way,
Right.
right? So I would argue that most conversations on CNBC, this is not an anti-CNBC comment, by the way. I think there's fine content there as well. Not everything, of course, but most conversations could basically stop right, wouldn't even happen if you could all agree on the same time frame. But most of these guys on these shows, they're just like, this, that, and the other. One guy's talking 10 years, the other guy's taking 10 minutes. You
Right.
can't have a conversation that way. So I think there's a misunderstanding of what time frame is. If you ask the average investor at home, are you bullish or bearish Apple? They will actually give you an answer. The problem is they didn't specify the time frame. Is it for the next 2 days,
Right.
2 weeks, 2 months, 2 years? They're just bullish. That means nothing. So that's one thing. Along the same lines, if we dig a little bit deeper, is understanding of where equity market returns come from. Your question was about the equity market. Well,
Okay.
first of all, the equity market has a correlation of like 0.95 to something called money supply.
Okay.
And there's a lot more details there, sort of through a quarter over quarter, at least, or year-over-year basis. So money supply drives pretty much explains most stock market returns. Most people don't even know money flows. They don't have to know what it is, but they should at least make an effort to understand where the stock market is from.
Okay.
The other thing is that fundamentals don't matter much in the near to intermediate term. So you can have a pristine balance sheet company, but money flows will drive the intermediate things. Like, for example, as we're recording this a few days ago or the week and a half ago, we've had a really massive squeeze in the equity market. A lot of that's based technical and really based on flows. So, making that, again, it's a time frame question. So when I say not understanding the market, they don't understand what drives the different time frames in the markets. And that's, and then the third thing if I could add on that, is really not even recognizing that there are other assets in the world than stocks. Right now, the stock market's important, but it's like about the fourth largest market in the world. So you have the bond market first, and you have well, depending on how you take swaps into that market and everything, and then you have currency markets. all those markets are way larger than the equity market. The equity market's important, but it's not the only market in commodities and so on and so forth. So, not what I started doing about 8-9 years ago, I started like walking people through what it looks like on a at least what I do on a professional's desk, I guess, looking at the markets. And they couldn't believe that I was looking at the dollar index and not at all looking at the equity index when I woke up. But I was telling them, if I know what the dollar's doing, I can more or less tell you with pretty good accuracy what the bond market's doing, what the equity market's doing, and probably what some commodities are doing. But it was mind-blowing to them to understand that the returns don't come from your favorite 50-day moving average on Apple, right? And I draw a simple line and then I go crazy on stock tweets and tell everyone how amazing my research is. But actually that is a pretty complex darn thing we're trying to do,
Very cool. Yeah, and some interesting perspectives, especially you bringing up the money supply. Now, part of it, I mean, and for anybody who goes and Googles money supply, if you haven't heard of it before, there are different money supplies that you can reference. So generally, are you looking at like the M1 or M2? The M3 is kind of a ghost out there.
Yeah.
I mean, what are you generally referencing when you're saying that, the money supply?
Yeah, I typically will look at M2, and then I'm just to be clear, I'm not a doctorate here on this kind of stuff. I just see the correlations. I've always followed them as I cut my teeth in the fixed income market. That's where I started as a bond guy. Okay. And so you tend to look more at those kind of things. But yeah, it's general just M2. And then there's also the velocity of money, is another thing you can look at. That tends to be a bit more accurate. And again, I don't try to be a doctor on this. I'm not. I just think a general idea of it is good enough. If you go to the St. Louis Fed website, if anyone cares to do that, have a look at that and type in M2 money supply and then add a chart of the S&P 500, or do it on your favorite charting platform if you have a decent charting platform like a Bloomberg or some of the other tools out there, and you'll see it's just the same chart. And by the way, we've now had a lowering in M2 money supply, like actually it coming down, like not stagnating for the first time ever, like ever. We've literally never had that before. And so it'll be interesting to see what happens to the stock market. I don't have an answer.
Well, okay, on that note, because I noticed when I first learned about money supply years ago, I found it interesting, just like with inflation, CPI and all that kind of stuff. A lot of it all depends on what they're including in calculating the number, because they change the definitions from time to time.
Yes. Yeah, just like the CPI basket, which is basically irrelevant in many ways, but
Yeah. Well, but no, well, I mean, as far as bringing up money supply and money velocity, that's a topic in and of itself that actually is very cool. If you're interested, or for anybody listening, we're not going to get into it here, but just look up, the velocity of money or money velocity. It's actually a really cool topic, and the whole field is very interesting and does have some impact on some things that you wouldn't think about, or you weren't aware of. So you might want to look that up. But anyway, no, with the money supply, I find that really interesting, but it makes absolute sense, because like when the pandemic hit a couple of years ago, and they're printing money and dumping it into the system and all that kind of stuff. I was, some people were coming to me and they're like worried, it's like, Brian, I got my money invested over here, I'm kind of nervous if we had hyperinflation or whatever, because they were seeing the parallels between the massive money printing and the blowing up of the money supply with other currencies, historically that have failed, because it definitely, are directly due to that. And so to see it actually shrinking now, to me, that's almost like is a reflection back in 1929, when JP Morgan kind of engineered the Great Depression, and the main trigger on that was collapsing the money supply that killed all the smaller banks. He had enough in reserves with his bigger banks that he could go around buy all the small ones up. But the thing that was killing the businesses and the economy was the money supply dried up. And so, yeah, you're bringing up the money supply as a driving factor. That's excellent. Very cool that you pay attention to that.
If you ever want to read a good book, and anyone, it's actually more of an encyclopedia in terms of its size. when I first started working at JP Morgan, I was a young buck, couldn't, green behind the ears. It was ridiculous. And this big, I'll never forget, I think I only saw him twice thereafter, big managing director with like, big tie, and like it was very intimidating. And he just pounded this massive book on my desk. And I literally more or less just sat down. And over the course of the next 3 years, it took me a long time to read it because it's a big one.
Yeah.
I read it. It's called The House of Morgan. I think it's what it's called, or The House That Morgan Built, or The House of Morgan, one of those two.
Okay.
And it's basically the JP Morgan story, and it involves the whole thing, and basically how he, some people will say that he kind of ended World War II, and this is not my words, right? I wasn't alive back then. Anyway, just really interesting how a banker at that point in time, way back from now, with communication being basically, nowhere near it is today, was able to have such a global influence. Really just fantastic.
Oh yeah, yeah, indeed. Yeah, I can imagine that the book on Morgan's an interesting read because he made some big things happen that actually still affect all of us today. Wasn't he also involved in the creation of the Federal Reserve Act?
That I don't know.
I'm thinking that he
I
was.
wouldn't be surprised. I mean, this guy was everywhere. It's just a fantastic story, and I'm planning on reading it again.
Yeah.
Again, it's a big one, but it's fantastic.
Huh. Okay. Yeah. I'm sorry. I didn't mean to take us down a rabbit hole here.
No,
But
no, no.
money supply and everything that actually is very, very, very cool. But it is worthwhile information though, and understandings that we don't just have the markets and they're there and they're in this isolated bubble. There are other significant factors that influence and sometimes drive the markets that aren't necessarily apparent to most your everyday person. And so it's good that you're bringing these things up. And right along with that, one thing that we talked briefly about is, of course, this podcast is about trading, and trading is, of course, that's why everybody's here because people are traders. But you and I were talking about the importance that for people to not have all their eggs in a trading basket. They with their wealth, they really need to be probably if they're going to be wise, especially with a long-term plan, don't be betting the farm on trading. Trading should be kind of off to the side, but you want to actually be managing the better part of your wealth, and hopefully with some help. And it's fun because here now we can say, and I got to throw the question out just because it's been baiting me ever since we started here. If you would just share your views on the difference between financial planners and investment planners.
Yeah. The difference between a financial planner or a financial advisor, we can play with the words here, right? But I'll just use the words that I use if you don't mind. So a financial advisor is typically someone who will make you a financial plan. They will allocate you money according to what the big firm they work for tells them to, which means basically you have three buckets and that's it, right? So nothing's tailored. And they'll send you a statement and they'll ask you how your dog is and whatever, and that's great, right? That's a financial and advisor, and that's important. You need a financial advisor, but that's not an investment advisor. An investment advisor typically is actually only available to people who have north of $10 million. Like Goldman Sachs doesn't take people, I think, unless they have at least liquid 20 million, and so it's typically reserved for that. Like we at Blue Marlin offer that for much more normal people. But what an investment advisor does is they're investment specialists. They're not there to, I mean, we make financial plans. We have people who do that for us. That's not me. That's not my game, but we have people who can do that. But it's investment advisors, right? So like we're there to actually, for example, assist people even if they want to trade with some of their money, right? So we'll allocate their money. We're in charge of the investments, specifically investments. But if they have a trade idea or something they want to call, they call us. If they call their financial advisor, that financial advisor does not know anything about the markets. In fact, I'll tell you, we have a lot of subscribers at the Study Trader that are financial advisors because they don't get the information they need. It's 100% true. They don't get the information they need from the company, the big bank that they work for, and so they need better information to advise their clients with.
Okay.
So I think people need to understand a little bit more what an investment advisor and how important it is, particularly for the trading community, which of course you attract here, right? Like, guys, really consider an investment advisor, like an investment advisor. Note the word here. It's not a financial advisor. It's someone who will call you with ideas, someone you can call if you have questions, right? Not every 5 minutes, but certainly several times a month if you have to. And there's a huge difference between investment advice and a newsletter.
Oh yeah.
Right. So newsletters are great. That's information, that's research. You do that, I do that. That's great. The problem is we cannot give you investment advice. But an investment advisor, which is why we created Blue Marlin Advisor for that. It's an actual registered investment advisor. We are registered to be able to give actual advice. Like, Joe, you have the so and so much in your portfolio. We think you should buy this and this much, like an actual amount of this and this call or whatever, right? That kind of thing. We can very get grounding. And I think a lot of people don't understand how the trading stuff correlates with their broader investments.
Okay.
And, as you say, most people should not, no one really, as far as I'm concerned, should be trading anywhere near more than 20% of their money. Like, I talk to our hedge fund networks and everything every day. There's not a single person that's a professional investor that I've ever come across that has more than 10, maybe 20% of their assets that they trade with. Like, not even close. Yet the investing public is still out there trying to live off of that dream. Now, again, trading I do it every day, right? But I do it with smaller amounts of money. And I think people are starting to wake up to that a little bit too. So as we speak here today, Robinhood announced their numbers. I think the stock is down about 15% because guess what? No one's trading anymore, right? Because it's hard. There's wonderful opportunities every single day, right? But as long as we have to keep in mind, it's a risk management exercise, and trading is great. And we do it, we want to do it, but let's do it with a certain amount of capital, not every penny we have.
Oh yeah. Well, another way to look at it, because I preach all the time, it's an old wisdom, but people being able to put it in a context that it's actionable. You've heard the wisdom, I'm sure, treat your trading as a business. Been around forever. But for somebody who's never started their own business or owned or run a business, they don't really have they don't have a concept of what that even actually means.
Yeah.
And so it's like, yeah, if you're working a job, you got your career, you've been there for 20 years, and it's like, yeah, I'm kind of tired of this. I want to strike out on my own. You wouldn't take all of your money and sink it into, like if you wanted to open a surf shop or a restaurant or whatever, you wouldn't take every penny you've got and dump it into that. You would take a little bit of your wealth and get the business up and running. And same thing you would want to do with trading. Yeah, like you were saying, you don't want to take the bulk of your wealth. You want to have it to be a small percentage because trading actually is a business. It's not investing. It's an investment in that business. But you're trading just like if you're trading any other goods or services. Yeah. It's an ongoing regular activity where you're buying and selling for profit. It's not long-term investing. And so but you have to treat it like a business. And if you look at it from that perspective, it's like, yeah, if I'm going to take my wealth, I'm only going to take a little bit and risk it on this business. I mean,
absolutely. And as far as, like you're all about little, it's in your name, right? The consistency of trading. And so I guess question for you, if you don't mind, sure. What do you think about, do you see people struggling with the concept of the non-linearity of returns?
Oh, sure.
Meaning people have this expectation that they're just going to make money every week, every month, every quarter, and they're not aware that that does not exist. Like there's always big drawdown, and big is relative, right? But drawdowns, and it doesn't matter where you are in June. It's more important where you are in December if you go calendar. Do you kind of come across that?
Oh, sure. Yeah. And again, a lot of it all depends on how you set up your business. The strategy that you use, because with any business, I mean, even if you wanted to get, say, real granular, let's say, you don't even want to open a restaurant, you want to open a pizza place. There's still 20 different ways to run that business, business models you could have. And so the same thing with trading. And what a lot of people don't realize is, they'll look at any business, like they drive by, or, retail, establishments, and they're thinking that those, trading is different from that because we have this huge uncertainty in the markets. But every business has potentially huge uncertainty to deal with. You got uncertainty, is your staff going to show up every day? Is the government going to shut you down on COVID? Is one of your suppliers going to crap out? Is the city going to decide to, build in front of your parking lot, for 3 months? You never know what kind of random event can have a serious impact on your business. So all businesses have, an element of uncertainty. With traders, it's a little more of a daily basis, but there are ways to mitigate that uncertainty and the swings, depending on how you go about your trading business. And like for a lot of traders, one of the best ways to mitigate it really is to keep their per trade risk low. That's one of the best ways to mitigate the swings. I mean, if you're betting, if you're going 5% in, 5% of your account on every trade, you're going to see some big account swings. But if you're only risking 0.5%, you can have 10 losing trades in a row, and it's only knocking you down 5%. So you're not going to have as big as swings on a per trade basis. But a lot of it, yeah, it all depends on how you strategize your business, how you're going to your goals from the for the business, how much time you're going to put into it, how well you're going to skill yourself up, the model that you're going to put in place, all that kind of stuff. So that there are a lot of variables in getting it sorted out. But yeah, as far as the linearity, back to your question, a lot of people, they come from a career where they've only worked for other people their entire life, and so they have kind of that employee mindset. I put in my time, I get a paycheck, and it's extremely linear. Okay, maybe I get overtime if I'm, if they're working me extra hours, but that's about it. And with business and trading, yeah, you can see some exponential moves that are very nonlinear. So it isn't equated to effort or resources spent as far as your returns. Sure.
Yeah. Well, we come across a lot of people that are either still quite young in their career and they just have very little life experience. I'm talking about, kids, usually boys in their 20s somewhere. So it's nearly impossible to describe that to them just because there's a lack of life experience.
Hmm.
However, we do see even more people just because they tend to have some more wealth in sort of the 50 to 65 bracket that want to retire. As you say, they kind of had it, they want to retire early, and they come in with the same expectation. Now they have more life experience, but I really always try very hard to warn them of the non-linearity of returns. And as you say, a lot of ways to mitigate that. One way is to not bet the farm. Other ways is to, use strategies that actually have hope. Most strategies, believe it or not, don't have hope.
True. Very
So,
hilarious, but true. Yeah.
Yeah, it's sadly hilarious, right? But I think that's one of the things where I always want to be. I'm always very careful, and usually when I say that, I would like to be a fly on the wall and see what the reactions are of these people, because a lot of times it's just phone calls. But I think sometimes it's shock, sometimes it's just, I'm not listening to this guy. It's like literally just, finger in my ears. So I think even there, it's once someone has that in their mind because they watched a lot of great commercials or infomercials on trading and all the amazing things that are going to happen, it's nearly impossible to get it out of their head. And so typically they have to trip over. The problem is the 20-year-old, 25-year-old can trip a couple of times, doesn't matter, he can get a job.
Right.
What we tend to see is with the 55, 60-year-old, and that's not old, by the way, right? Now we are expected to live much longer. It's going to be more difficult to make up those losses. And they tend to make very silly mistakes, usually out of just frustration because they don't want to be in their job anymore. And I can fully understand that. I just wish I had more ways of walking them off the ledge. And it's hard, it really is hard.
Oh, yeah. Yeah. No, part of the reason I was laughing there is, as far as, yeah, some ideas being ridiculous, but also you mentioned earlier, like as far as the golfing and everything, and things that don't help as far as the view that people have. Remember several years ago, I think it was E-Trade, where they they had the baby.
Oh,
Um,
the old E-Trade commercials. Those are 90s late 90s commercials when they
yeah,
started.
those were so hilarious. But a couple of my favorites was where he's in the clubhouse of the
In
golf.
the clubhouse, yeah, yeah, yeah. Not being able to pay in it goes something like this is weak, man.
Calling the other guy Shankopotamus and all that.
Shankopotamus, exactly.
Those commercials did not help the average consumer. They helped the company a lot because they conveyed this message. Oh yeah, so easy a baby can do it. It's like no, dude, you're just dragging people down the wrong road.
Oh, for sure. And this is in the late 90s, right? Or into the early 2000s. Those E-Trade babies retired, and there's actually one that came out just after, during or after the pandemic about the E-Trade baby coming out of retirement. Have you seen that one? He's
No,
now he's a lumberjack somewhere, and they come in with a helicopter, and they're trying to getting him. It's anyway, and that happened right at the peak of the market again. So the E-Trade baby made its appearance at the peak of the dot-com bubble, more or less,
right.
and again at the peak of the post-COVID bubble. So great timing.
Uh,
But I would argue, honestly, with the advent of the phone and everything, and brokers, and this is not an anti Robinhood comment, just to be clear, I'm tend to be quite neutral on this, but the gamification of this and the ease of access on our phones and the confetti flying, you know, that does not help. It really doesn't. Back with the original E-Trade babies, you still had to actually be on a physical computer. Now you can be in between two shanks on the golf course and wank out a trade, right? Um, it's crazy, you know.
True, true. Well, okay, so back to what you do in with the Blue Marlin Advisor. Um, you said that you are filling a gap or a gap in the market because the bigger banks are targeting mostly 10 million liquid and over investors. You said that you can provide your services for people that aren't necessarily at that level of means. So, what actually is the group that you would be able to service with your Blue Marlin Advisor?
Well, the reason I've always done this kind of stuff, right? So I've always done investment advisory, fund management, all that kind of stuff with people that are in market. So a lot of times I do this for like family offices or high net worth people, but it doesn't mean that they have to have a fortune. The reason that banks can only offer that kind of service to those people is because they have a whole department of people that cost $500,000 each, to call you. We don't have that overhead, but we can do that. So, I mean, we've got people, starting around $250,000 where you can start doing that. And again, it's not day trading. We're not going to call them every 5 minutes with a day trade. That's insane.
Right.
For that, we have chat rooms and stuff on the steady trader side. But, what I think is important is for people to have someone to talk to, you
Mhm.
know, and I know you offer great services. We have services, and that's great information, but it's not someone you can talk to, someone who knows you specifically.
Mhm.
So I think what people really should consider is, if they're self-directed investors or at least part-time doing some of it with their own money, they
Mhm.
should take your research and your stuff or wherever else you want to get it from, right? You get it from anywhere, but then you need a partner. You need to talk to someone about this.
Mhm.
And like your neighbor who looks at the stock market once a day, that does not count. Like, it needs to be someone who's got a pulse in the market. And I think if people did that, they would do a hell of a lot better than they're doing. Not even because they're going to be doing more profitable trades.
Mhm.
They might, but because they can do less stupid mistakes.
Oh yeah.
And like I see it's just mind-boggling sometimes. Like, someone buys a stock, they're not aware the stock's reporting earnings in 2 hours after the close, or they say, okay, well, this is great. This company's reported earnings last night. I'm going to buy the stock at the open or whatever, and then the company has the earnings call, the actual conference call at 10 o'clock East Coast time, and then everything changes. It's just things like that, or not being aware of like major economic reports, or not being aware that the stock market's the most highly correlated asset class in the world. in terms of publicly traded markets. Just all sorts of things like that. Like if you can literally have someone just keep you away from doing that, most people would do a hell of a lot better than they're doing.
Yeah.
And not to mention the fact that none of it's tailored when you get a newsletter. Like we're not allowed to give anyone advice. We can give them research and ideas.
Right. Well, now as far as your investment advisory, so do you keep your focus primarily to the stock and equity markets, or do you also, when you're working with somebody, if they say, well, I want to invest in real estate, or some of these investment areas that are completely away from the stock market, do you work with them as well?
Yeah. So my thing has always been more a bit global macro focused,
Okay.
which is really more of an asset allocation view of things. It's an understanding that the stock market does not live in isolation. It's, as we said before, right? There's other markets around the world. Now, the average US investor doesn't want to care about, I don't know, let's say Japanese stocks or whatever, like something that's rather outside the country. So a lot of stuff the people like to do is just, nowadays we have ETFs. And
Right.
ETFs are wonderful in the sense that you can more or less play the world with ETFs. There's an ETF for almost anything. There's an ETF for too many things, probably, two times over. But if you want to take a view on, French bonds or European bonds or the German DAX or anything inside the United States, of course, there's an ETF for that. Now it's not perfect, and but it's good enough for most cases. So I like to focus. It comes back to a diversification game. Like if I look at the people that we advise that are rather high net worth, like their idea of diversification is so much more than most people could ever imagine. Like it goes all the way to having different custodians. Like I'm in Switzerland a lot of times. As I think I told you, I'm also Swiss.
Right.
And so one of the things that a lot of the wealthier Americans do is they also have some money at an SEC registered Swiss investment advisor. Okay, so this is no more offshore, hiding money from the SEC. These are completely kosher SEC registered Swiss investment advisors. So why would someone do that? Well, diversification, right? So let's say you have an account, or one has an account at whatever bank, XYZ. I don't want to name a name. Let's just any typical US retail bank. And let's say you might be a surgeon, right? And you get sued.
Right.
Well, ultimately, it's a lot easier for your money to be taken away from you at your local bank than it is to ultimately go to that foreign jurisdiction where it's 100% accessible still. But I mean, there's so many different ways, for diversification.
Okay. Well, so you do focus primarily on financial instruments, not.
Yeah, we do liquid markets. I'm sorry, I should have addressed that. Yeah, I mean, we'll look at other stuff. I'm not a real estate guru. We have people that do that, where we get people to that are very, very deeply focused on that. But our focus is more on the liquid investment part. It goes into structured products, it goes into structured notes and special situation deals and things like that. But one of the things I learned early on is that you can't be a jack of all trades.
Right.
Although YouTube does a really good job trying to convince you that one can be or one is,
Oh, yeah.
But I don't know a single person that is good at private equity, really good at private equity, and also understands liquid publicly traded markets very well. I don't think it really exists.
Okay. Fair enough. No, I was just curious because we're comparing the difference between like the traditional financial planner and an investment advisor. And I know that we've got like the financial instrument world, and then business, like where you're buying and selling businesses, like when mergers and acquisitions, or real estate, or the venues or whatever you want to call it is where you can go invest your money. It's a pretty broad range. I was just curious if you were working in these others as well. So no, that's cool. So now with your trading service, the steadytrader.com. Now, okay, we've been talking about mostly the investment side of things, but with your steadytrader.com, you've got your methodology that you've developed, and your way that you approach the markets. And so you also there now you've got a couple of different courses. You've got your scan, what is it, a scanning tool, and then you also have your community, correct? Could you
Yeah, the
tell us
study
about
trader.
what you got there?
Yeah, sure. Well, what happened is when I was working at JP Morgan,
Mhm.
one of the things that I was doing is I was writing this morning note. So
Okay.
when you work in an investment bank, you get all this research sent to you every morning internally.
Right.
And what I did is I would summarize some of that stuff in my own terms,
Mhm.
but I made it sound a little funny. Like it wasn't like comedic, but it was, I also put in some pop culture, and so it became a really fun read in the morning.
Right.
And so after about 2 years or something like that, I on the Bloomberg terminal, you can see who opens your message, a message for function. And so after a couple of years, I was looking at who's opening my messages, and my clients were all like really big asset managers like UBS or huge reinsurance companies and those kinds of things and some corporates. And I realized that like 80% of these people were opening my email. And these are like chief investment officers and stuff like that. And I was like, man, this is pretty cool. So ultimately, when I quit JP Morgan, I left and I just figured I'd continue kind of these thoughts and then just a lot of people ended up following me and my own thoughts that were on my distribution list at JP Morgan and so on and so forth. And then what I basically ended up doing is developing an entire ecosystem out of the my investment process that I had learned
Mhm.
and was using, including building software, different strategies that I developed, and that has turned into the studytrader.com, where we have multiple different option strategies. We do some future stuff, a lot of equities and ETFs, of course, including proprietary scanners and a couple of really neat indicators that come with chat rooms and courses. It's just a whole thing, right, for people to really educate themselves and trade or invest on their own.
Okay.
Yeah,
Cool.
so that's
Well, now you also have your daily traders alert, right? That
yeah. We one of the things that one of the programs, for example, includes like a trade of the day.
Mhm.
Where we send out a trade every day when there is one to do. It's usually like a swing trade, but that's great. Gives you profit targets and stop losses. But I think to me, and I don't know, I would love to hear your thought, but to me, it's much more important what's the context of a trade rather than the specific exact target in target one and two and stop loss. Now that's important,
Mhm.
but I'm more interested in what's the context. What's the reason for a trade? So, like for example, 2 weeks ago, we would close out of our shorts.
Mhm.
That we've been, or when you buying something, like what's the reason for buying something? Like I would much rather get an alert that says, okay, today I'm buying this because of that.
Right.
And it's not, yes, there might be a moving average or a line or something technical, but at the end of the day, the thought is usually much more complex. It's usually a couple of degrees away.
Mhm.
It's a little bit like, you're obviously very studied as an engineer. It's and you could probably explain this better than I can, but it's the butterfly effect thing, right?
Oh, sure.
Where like, what's a butterfly flapping its wings have to do with a hurricane, out in the ocean?
Right.
Um, I think that is to me is much more interesting. I wish more people, and well, I should say this. I think once people understand that that's more important, and we give them the exact profit targets and all that, but once they can understand the context,
Mhm.
they have a much easier time adhering to the risk parameters we send out.
Well, that makes sense. Sure. Yeah. So just from being able to execute it and trust what they're doing. Yeah. Oh, yeah.
Exactly.
That's the big deal. Yeah, because I mean, one of the main reasons that people are making mistakes is because they're second guessing themselves, or they have self doubt or doubt in their system and that kind of stuff. And so that's where a lot of the mistakes or hesitation or chasing trades, all that kind of stuff comes into play. Is just that lack of confidence and
Well,
trust.
it goes to what you're preaching about the consistency, right?
Mhm.
I mean, what if you look at the consistency or the lack thereof? What is like the number one or two things that you see reasons why people are not consistent or not as consistent as they could be, maybe?
See, actually, that's a question I had for you.
Yeah. Okay, sure. I'm happy to answer. I'd love to hear your thoughts too, though.
Oh, well, no, for me, the answer is pretty easy. Um, I mean, the biggest obstacle most traders have for in dealing with inconsistency, one of the primary ones is a lack of good training. They're trying to do a job that they're not prepared for. and that undermines everything else. If you get to training where you actually know what you're doing, you understand, why you do what you do and why it works, all that kind of stuff. Like I said, you just plain you have a good handle on, and you have the skills and the knowledge base to, again, know what you're doing. That takes care of almost everything else. But if you're lacking that, you can throw everything else at it, and it's going to be of limited value. So, but for you, I mean, seriously, that's one question I ask all my guests, because it's the Consistent Profits podcast, is, yeah, what do you see as one of the biggest obstacles?
I had no idea. I wasn't trying to steal your thunder. I'm sorry.
Oh, it's hilarious though. You're the first one that's done that. That's cool.
Sorry, man. I'm sorry about that. No, I think I agree with definitely with what you're saying. I would argue that the lack of consistency has to do with the lack of really what I've been saying here for the past however long we've been chatting, the lack of understanding of how, of the fact that the dog wags the tail. It's like how I like to say it.
Good metaphor, yeah.
So we just did our annual summit in Orlando, and I usually start these things off with a beautiful picture of a beautiful a golden retriever. I mean, just super beautiful dog, and I'm not like a pet freak, but it's just a gorgeous dog,
right?
And with a long tail and just beautiful. And I try to explain people that a lot of people will use they'll pull up a chart, they'll pull up the 50-day moving average, or they have a magical unicorn Fibonacci number or something, which are not unimportant, by the way, right? But that's all they do. It's called a single factor analysis. An engineer, you can appreciate that that's not very helpful. And so then they draw that line and they see that's exactly where the stock is right now. So it's going to hold there, or it's going to bounce or find resistance here. The problem is that you're looking at the tail, right? That tail, that moving average will not dictate what that stock's going to do. Like it might, but it might not. So it's essentially, it's nothing more than a coin flip. The reality is that the dog that's going to make that tail move is more something like an important economic data point. It depends where we are in the economic cycle, an earnings report, right? Something like that people find boring as all hell. The problem is it's ultimately what's going to either make you money or push you to the poorhouse. So I think that is probably the biggest lack of consistency that I see. People's unwillingness to care about the things that actually move markets. Like we started off with money supply. Mm-hmm. How many people do you talk to and can you get excited about empty money supply? If you were an infomercial at 2 a.m. and or let me give you this example. I'll bring it back to the golf channel, since you and I talked golf before. Okay. This is a true story. You know who Jim McLean is? He's a golf teacher. Oh, yeah. Yeah. Anyway, he's got the 7-step or 11-step golf swing DVD. This is like 20 years ago.
Right.
He would have this thing on the golf channel, and he would be like, literally, like, he would have like this fan of like 20 DVDs. It was insane. Like you learn his 7 or 11-step golf course in 20 DVDs. The next commercial right after that this is true story, was this it was a new driver with some like volcano face, like something face, whatever, and he would hit the ball 320 down the middle every time. What the hell do you think people are going to buy? So there's there's underwear trader XYZ on YouTube pretending to trade by the pool, flashing his amazing new unicorn indicator. Right. And then there's me talking about M2 money supply. What are people going to buy? That's the problem. People are unwilling to learn what actually moves the markets.
Yeah. Of course, part of it does depend on how geeky the people are that you're talking to. Because see, somebody like me, you bring up money supply, yeah, I get fired up.
Of course, but you're also experienced, reasonable, and you can, I think, tell apart from what's realistic and what's not. Oh, yeah. And I think I would even take this a step back and really bring it back to, are you in the markets to make money, or are you doing this for entertainment?
Oh yeah, big time.
And that ultimately is the difference. If the people who are actually serious about it, and by the way, those people 9 out of 10 times will ultimately also get an investment advisor to help them do the stuff they're trying to do themselves, right? Just as an FYI. But if they're serious enough, they will understand, A, there's no quick fix, right? B, I need to lower my expectations. And I just gotta take it serious. I have to treat it as a business, like you say. And you can really bring everything back to that. But the people who are in it for entertainment, I hear so many people coming to us and like, oh yeah, I'm serious. And then what happens? I hear back from them a month later, oh, I was on a cruise. On a cruise? What? I mean, that's great that you went on a cruise, but I thought you were trying to make the trade and manage. Oh, I was on a cruise. I had left my positions open. You guys, you can't do that. Then you shouldn't be a trader. And then maybe be a day trader. The problem, and a lot of people say, and here's another thing. Oh, I'm going to be a day trader because I don't have time. That's already a problem right there. And if I close my positions, then I can go on vacation. Okay, so here's the fallacy with that thought. So you're going to go on vacation, and you're going to tell me in those 2 weeks you're on your cruise sipping cocktails, that is exactly when the market is going to give no one any opportunity. And when you come back, that's when all the opportunity is going to be. If they just waited for Jim to come off the boat. No, that's not how it works, right? So then why are you trying to be a trader? It's not going to work, man.
Yeah.
Yeah,
that is funny though. No, you're right though. There are some people, and well, part of it is just being honest with themselves. For some people, not the majority of people that have come to me, but I've run across a handful of them where, yeah, they need to admit to themselves that they're honestly not really doing their best to make money at it. A lot of it is the thrill ride, the rush, and you can just look at their track record. I mean, I worked with this one guy, and it took him a while to sober up. I mean, he had to lose about 300 grand, and then he's like, okay, yeah, I'm done messing around. I want some help. But he had to lose the 300 grand because prior to that, it was just, yeah, make some money, give it all back, fund the, lose more, fund the account again, and go through that cycle over and over and over again. But he was addicted to the rush. He wasn't using his best judgment, even when he wasn't in the trading. He still wasn't looking at things like, I want to take this seriously and make money at it. It was like, well, I want to, and it was the excitement was what was driving it. And so, yeah, it's just he had to finally be honest with himself that, yeah, it was the rush that he was here for, not to make money. And so, but yeah, you bring up a lot of good stuff, and you do have a good sense of humor and everything with the metaphors you bring up. It's great. So, um, well, anyway, so we do need to wrap this up. Actually, we've been talking for close to an hour now, so we've been way over the normal limit, but absolutely worthwhile. I've thoroughly enjoyed this conversation. And for everybody that's listening, if what we've talked about resonates with you at all, you are serious about it, you do understand trading is not, the end all be all, for your financial future. You do need to be looking elsewhere, some diversification, and, have your eggs all in this basket, but elsewhere, and wisely invested. If you'd like some help with that, Serge does have some good services. He does believe in, working with you, and, beyond, he can help you with the trading, but also with the investment side of it. So definitely, swing by the bluemarlinadvisor.com, correct? To connect with you there on that matter, and the steadytrader.com for the trading help. But yeah, don't just listen to this and say, "Yeah, that was fun," and then forget about it, and don't do anything with it. If, like I said, if any of it resonated with you and you're serious about making money, go ahead and connect with Serge, and engage him in his help, because he's a good guy. You can tell that he's got his head on his shoulders, right? He knows how to communicate. He's a pretty smart guy, and he's got a good measure of success that he can help you reach your goals as well. So,
I'll say this, Brian.
Yeah.
First of all, I thoroughly enjoyed this.
Mhm.
This was a lot of fun. I love these conversations, but also I think what you stand for, the consistency of profits, or success, however you want to put that, is really, really important, right? It's really about the repetition, and again, understanding that there's no linearity in returns. There's a difference between expecting linear returns and becoming more consistent, which I'm sure you explain to people, but that is a hugely important fact. So I could congratulate you for taking that upon you, because that's really very, very important.
Oh, thank you. Thank you. Well, any final words of wisdom for our audience today?
I would say diversify. And when I say diversify, this does not mean that I need to, buy Coca-Cola and some Cisco systems and some whatever. I think that's important. However, even from a trading perspective, we're talking about, more proactive stuff here as well. One of the things that I see a lot of people do is have, no shorts versus longs. And from a trading perspective, I would argue that's not very well diversified, because something's always going to go up and something's always going to go down. So,
Yeah.
important.
Not being a one-trick pony. Yeah, for sure.
Yeah.
Very cool. Well, again, thanks for taking time out of the day for doing this. And everybody that's listening, applaud you as well for taking time out of your day to, attend and learn and, develop and grow as a trader. So again, if you found us worthwhile, definitely act on what you found here, and connect with Serge. And we'll talk to you on the next episode of the Consistent Profits Podcast. Cheers. Thank you for joining us today on the Consistent Profits Podcast, brought to you by Inside Out Trading. Make sure to swing by InsideOutTrading.com and pick up your free copy of Break the Cycle: 10 things you can do to stop reinforcing the past and get your trading on the right track. If you enjoyed the show, make sure to subscribe on your favorite channel, and we'll see you on the next episode. Cheers.